On July 14, 2026, three things happened simultaneously that together changed the economic outlook more dramatically than any single day in the past 6 months. First, inflation data. The Consumer Price Index for June 2026 came in below expectations across the board. Headline CPI rose 3.5% year-over-year, equaling the lowest reading since 2020. This is a dramatic drop from May's 4.2%, which had the Federal Reserve discussing rate hikes and Goldman Sachs pushing its first cut forecast all the way to 2027. Second, Goldman Sachs reported second quarter earnings that crushed every analyst estimate. Goldman reported earnings of $20.98 per share, against analyst expectations of $14.48 per share. Revenue of $20.34 billion beat the $16.30 billion consensus by more than $4 billion. Goldman Sachs stock rose nearly 8% on the day. Third, IBM's CEO warned investors that second quarter results will disappoint. IBM shares plunged 24%. The company cited a shortfall in its Z-series mainframe performance and the associated software stack. Today, July 14, 2026, is the exact day that crystallizes everything this channel has been documenting for the last 13 episodes. The inflation reversal changes the Fed calculus from video 40. Goldman's blowout earnings confirms the K-shaped economy from video 29. IBM's collapse vindicates the AI infrastructure warning from video 33. And the gap between Goldman and IBM in a single morning is the clearest possible real-world demonstration of the two-speed American economy we've been tracking. Today I'm going to tell you the full story of what happened on July 14, 2026, what it actually means for the economy and markets, and whether the three narratives that have dominated 2026, sticky inflation, AI exceptionalism, and financial market strength, are now being rewritten in real time. I'm pairing this with Roger Lowenstein's When Genius Failed, the definitive account of what happens when confident market models run into a world that doesn't follow their assumptions. Because today's inflation surprise is exactly the kind of rapid reversal that destroys overconfident positions. And Lowenstein documented the template. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. The inflation surprise and why it matters so much. Let me be precise about what the 3.5% CPI reading actually means. Just 30 days ago, in the Video 40 episode we released last week, Goldman Sachs had pushed its first rate cut forecast to 2027. 9 Federal Reserve officials were projecting at least one rate hike this year. The CME FedWatch tool was showing 0% probability of a July cut. The narrative was, inflation is stuck, rates stay high, maybe even go higher. The June CPI reading at 3.5%, down from 4.2% in May, is not just a normal monthly fluctuation. It's a 0.7 percentage point drop in a single month. That's a dramatic deceleration. The last time CPI was at 3.5% was in 2020 during a unique pandemic-era economic contraction. Seeing this level in July 2026 suggests something important may have changed in the underlying inflation dynamic. What changed? Energy. In May 2026, the Iran conflict was pushing oil prices sharply higher. The CPI was driven in significant part by energy costs pushed higher by ongoing geopolitical tensions in the Middle East. Between May and June, multiple factors shifted. Trump's decision to abandon the 20% Strait of Hormuz transit fee, replaced with trade deals, eased immediate oil market concerns. Oil prices pulled back. West Texas Intermediate is now trading at $79.56 per barrel, up modestly today, but far below the spike fears of a month ago. When energy price pressures ease, as we're seeing, CPI can decelerate sharply, and today's data suggests that's exactly what happened. Part 2. What today's CPI means for the Fed and for Video 40. Here's where it gets genuinely interesting. Everything we covered in Video 40 just got complicated. We discussed 3 scenarios for the second half of 2026. Scenario 1, hold all year, Goldman says cuts in 2027. Scenario 2, the Fed hikes in October or December. Scenario 3, Iran tensions ease, energy falls, inflation moderates, cuts return. Today's data is Scenario 3 playing out in real time, less than 1 week after Video 40, with many analysts and the broader market largely pricing in the potential for a rate hike by the end of the year. Today's 3.5% inflation rate update may temporarily hush these talks, which is great for growth stocks, as the market showed. The implications are significant. The Fed's July 20th meeting just became dramatically less predictable. A month ago, the question was whether the Fed would hold or hike. Today's data reopens the possibility, however small, that the Fed shifts its language back toward a potential cut later in 2026. This doesn't mean cuts are coming immediately. 1 month's data isn't a trend. The Fed needs to see sustained progress toward its 2% target, not a single month's improvement, but it does mean the October hike scenario from Video 4D just got significantly less likely, and it means Goldman's 2027 forecast may itself be revised earlier if the next 2 or 3 months continue the disinflationary trajectory. Part 3. Goldman Sachs, the clearest possible K-shaped data point. Goldman Sachs reported earnings of $20.98 per share against analyst expectations of $14.48 per share. A 45% earnings beat is extraordinary by any standard. Revenue of $20.34 billion beat the $16.53 billion consensus by over 25%. Goldman's stock rose nearly 8% today, adding billions to the firm's market cap in a single session. What drove the blowout? Investment banking and trading. Goldman's fixed income, currencies, and commodities trading desk generated exceptional revenues in a volatile market environment. The geopolitical uncertainty, the Iran conflict, the rate debate, the currency movements, all of this market volatility is Goldman's business environment. When markets are uncertain and volatile, investment banks that help institutions manage that uncertainty make money. More uncertainty equals more trading equals more Goldman revenue. Now contrast this with the average American household. Higher for longer rates are crushing credit card borrowers at 21% APR, a story we covered in video 32. The housing market remains inaccessible. 2 out of 4 free 2 cities with $1 million starter homes from video 31. The median American worker has $955 saved for retirement from video 28. Goldman Sachs made $20.98 per share in 3 months. The median American household didn't. This is the K-shaped economy from video 29 rendered as a single morning's earnings data. The top of the financial system, investment banks trading volatility, is thriving. The bottom, households struggling with survival debt, is under the most financial pressure in years. Goldman's beat is real and impressive. It doesn't change the household reality. Both things are true simultaneously. Part 4. IBM, the AI infrastructure warning comes true. IBM CEO Arvind Krishna warned investors that second quarter results will disappoint. IBM cited a shortfall in its Z series mainframe performance and the associated software stack. IBM's shares plunged 24% intraday, one of the largest single-day drops for a major US technology company in recent memory. This matters specifically in the context of Video 33, the AI infrastructure boom, and who actually wins. IBM made a strategic bet on AI integration into its enterprise mainframe business. The bet didn't perform as expected in Q2 2026. This is exactly the kind of earnings disappointment that Christensen's Innovator's Dilemma framework from Video 33 warned about. The AI infrastructure boom creates enormous opportunity, but it also creates enormous pressure on companies to make expensive bets that don't always pay off on the expected timeline. IBM is not a small company, it's not a startup, it's a 130-year-old technology institution. When a company of that size reports a 24% single-day stock drop, it's a reminder that the AI boom isn't a rising tide that lifts all boats. Some boats are getting swamped by the wave, and it creates a specific data point. AI-driven infrastructure spending is squeezing capital expenditures for non-AI technology, including IBM's mainframe hardware business. This is the crowding out effect that Goldman Sachs and others have warned about. AI capex is so large that it's reducing spending on other technology categories. Part 5. What Roger Lowenstein tells us about today. When Genius Failed is the definitive account of LTCM, the hedge fund that we covered in video 21. Lowenstein's reporting captures one moment with perfect clarity that applies to July 14, 2026. LTCM's models assumed that the relationships they had observed in historical data would persist. They didn't build in the possibility that the world could change rapidly in ways their models had never seen. Between May and July 2026, 2 things changed faster than most models predicted. Inflation, which was tracking toward rate hikes, decelerated sharply after energy prices moderated, and IBM, which was expected to benefit from the AI boom, reported a massive earnings miss driven by AI spending crowding out its traditional business. Both of these outcomes were within the range of possible scenarios. Neither was impossible. Both surprised the consensus. Lowenstein's central lesson: models are calibrated to historical data. When conditions change rapidly, models fail. The investors who survive are the ones who have built portfolios that don't depend on any single scenario being correct. This is the honest framework for everything we've covered in this series. The 6-40 portfolio discussion in video 39, the 3 scenarios for the Fed in video 40, the gold diagnostic tool in video 37, the all-weather portfolio in video 39. All of these are attempts to build portfolios that don't depend on perfect prediction, because prediction is impossible. July 14, 2026 is proof. Part 6, the practical implications for your portfolio, updated for today. Here's the honest, actionable section, specifically updated for what we learned today. First, on inflation and the Fed. Today's 3.5% CPI reading is genuinely good news for anyone who was worried about rate hikes. It reduces the probability of a Q4 hike meaningfully. It doesn't guarantee rate cuts in 2026, but it opens the door to a shift in Fed language at the July 29th meeting, possibly from neutral toward mildly dovish. What to do? Don't make dramatic portfolio changes based on 1 month's data. But if you've been holding excess cash in anticipation of needing it for a market downturn driven by hikes, this data slightly reduces the urgency of that defensive positioning. Second, on growth stocks. With many analysts pricing in potential rate hikes, today's 3.5% inflation rate update may temporarily hush these talks, which is great for growth stocks. Today's market reaction confirmed this. The Nasdaq rose over 1% while the low volatility index fell. This doesn't mean load up on growth stocks. It means the near-term rate pressure on high multiple stocks has eased slightly. Third, on AI stocks specifically. IBM's 24% single-day collapse is a specific warning about AI infrastructure timing. Companies betting on AI monetization on a specific timeline face significant earnings risk if that timeline slips. The shovel sellers from video 33, power companies, data center operators, cooling systems, are more protected than the application layer companies. IBM's miss is an application layer story. The power and infrastructure layer, Bloom Energy, Vertiv and Vent, wasn't what IBM was selling. Fourth, on the K-shaped economy. Goldman's blow on earnings and IBM's collapse on the same morning is not a contradiction. It's the system working exactly as described in video 29. Volatility generates Goldman revenue. AI timeline slippage hurts IBM. The average household experiences neither of Goldman's upside nor IBM's specific downside. They experience their own version of financial stress documented in videos 28 through 35. Nothing about Goldman's earnings changes the retirement savings crisis. Nothing about IBM's miss makes mortgage rates more affordable. Keep perspective. Final verdict on When Genius Failed. Should you read it? Especially now, in the context of today's inflation surprise. Yes, Lowenstein's account of LTCM documents one of the clearest examples in history of what happens when smart people with good models are surprised by a world that moves faster and more dramatically than their models predict. June 2026 CPI data and IBM's earnings are small-scale versions of the same phenomenon. My rating, 10 out of 10. The most important book ever written about the failure of quantitative confidence in financial markets. The bottom line for July 14, 2026. Inflation just dropped to 3.5%. Goldman just printed one of its best quarters ever. IBM just lost 24%. The Fed's rate hike narrative just got complicated. All on the same morning. This is what honest financial analysis looks like in real time. Not a single narrative, not a single direction, but a complex, contradictory, genuinely uncertain world that rewards patience, diversification, and intellectual honesty. If this series has given you a more honest picture of the 2026 economy, subscribe to Earnings Per Page. Drop a comment with which story from today surprised you most. See you in the next one.